You're listening to The Real Investment Show.
Welcome back to the show this morning. It's 6:33. So just talking a little bit about, the exuberance in the markets. Everybody's making money. It's all fun and games. It's pretty much like a casino, right? The great thing about the reason, if you ever go to Vegas, by the way, Vegas is not a happenstance area. Right. I mean, things just don't happen inside of a Vegas casino for just random reasons. Right. There's a reason why there's lots of bright lights and bells and sirens on top of jackpot machines and all that stuff. It's all very specifically designed to tap into your psychological behavior. And to drive you. If you see other people winning and doing things, you hear the bells going off, you see the lights flashing, that makes you want to go and spend money, right? Because you want to get in onto it too. Social media is designed specifically to tap into that dopamine effect, just like Vegas, in order to get you to continue to like and post and scroll, because every time you like something, every time, I tell my kids this all the time, is why are you making all your friends money rather than you're just sitting around looking at stuff? Because every time you like something, every time you scroll past it, those ads that you just scroll past, you don't have to actually look at the ad, you just have to scroll past the ad, and advertisers pay money for that. It's all designed to tap into that dopamine effect. The stock market works exactly the same way. When markets are going up and all the lights are green, you want to get into it, you want to chase it, you want to do these things, and you don't think about the risk, right? And the risk is how much money you lose when something goes wrong. That's what risk is, right? So we were just talking about that before the break. But it's interesting because when you look at the population of the country, you would think that with the stock market going up, everybody's making money, right? Everybody's got to be in this. Everybody's got to be doing it. But it's actually not the case. If you take a look at 401k plans, one of the beliefs is that, and I hear this a lot, it's like, well, everybody contributes to a 401k plan now. No. Only about 50% of employees in the country have access to a 401k. And believe it or not, only about 50% of those people, about 25% of the population, actually contribute to a plan. And very few of those, roughly half, actually maximize their contribution to a 401k plan every year. So you're talking about 1/8 of the population that actually maximize the benefit of their 401k plan. And we know this because we look at 401k plan, Fidelity and Schwab and others put out the value of their 401k plans every year. And they'll say, there's a record number of 401k millionaires. And then when you actually look at the number of accounts that are the $1 million 401k plans, guess what? It's 1% of the total number of the 401k plans. Exactly what you would expect from the population, right? The average balance is about $50,000, $55,000, about 1 year's worth of salary for most Americans. So, this is a problem. People making $100,000 and more, right, are concerned about retirement. They have less than, $500 in the bank. And while we talk about how great the market's doing, the reality is and this is when we talk about the wealth gap as well. One thing that Danny works on all the time with individuals is looking at, what they're spending, what the future value of that money is going to be, and what's going to cost to live. And with interest rates at, less than 1%, the challenge of meeting retirement income is going to be problematic.
This is a common conversation that we're having. So first and foremost, we see that 401k, those numbers up close and personal. We help a lot of businesses with their 401ks. And especially this time of year, we're going through making sure that all the funds are still good funds to invest in, that people are participating. We're getting, information out that's required by law. And so we're spending a lot of time. And I'm seeing those numbers that you're mentioning right now, Lance, that the participation rate is between that 50 and 60% range. And this is the people who have a lot of access to this. They have lots of information about it. It's not something where it's necessarily an afterthought. And so we're seeing that quite a bit. But the other conversation is how do you diversify assets? And you mentioned, talking about the wealth gap and how it used to be where, we've talked about this frequently. We used to be able to go get 4 or 5% out of fixed income, no problem, with very little risk. those days are gone. And so, I mean, it's a common conversation we have of what does even our fixed income portfolio look like here in the future, just in general, and where do we go with how do you invest? And I think that's going to be a problem where a lot of these plans are going to be stuck because you just don't have the options to get a little bit more creative to build some fixed income. And I think that you're going to see a lot of people taking on additional risk that they don't realize.
Well, honestly, that's what you're seeing now, though, right? I mean, we talk about, the attitude of people wanting to chase markets, et cetera. Markets are going up. Why would I own fixed income? I want more return, right? I want more, I can get a higher rate of return from stocks than I can from bonds. True, for the moment. But this is also part of that moral hazard from the Federal Reserve is that they've driven rates to such a low rate, less than 1%. That it's forcing people into the stock market to create some form of return. I can't get a return on cash. We just looked at a bond yesterday from Ford Motor Company, right? Now, they make automobiles.
Isn't Tesla going to buy them?
They should.
I'm kidding.
They should. But no, Ford Motor Credit, right? Been around 100 and some odd years, et cetera. It's a junk rated company. Ford Motor Company is junk rated. They are double B bond. Now, you would expect for a double B bond that I should get about a 4% yield, roughly 4 to 5%, to buy junk. And that's really kind of ridiculous to be buying junk for a 4 or 5% yield. It should be around 9 or 10, ultimately. That's what the normal credit risk rate for a junk bond is. The bond was yielding 2.75%. So this is where we are in the markets. We've driven rates that even now taking on credit risk is no longer advantageous. So why would I buy a 2.75% junk bond when I can buy a stock that'll yield, 2.75 and potentially in a day, right? If I happen to catch it on a good day, a stock can be up 4 or 5% these days. That's because that we have a real lack of liquidity in the market that's causing these massive price movements. And we see Disney is a good example. Disney reported an announcement on Monday that they expect to have 86 million subscribers by 2025, I think, on Disney Plus, right? Sounds fantastic. People ran the stock up 15%. Now, this is Disney, who has no park revenue at this point, is financially, really stressed because of what's going on within the economy and is very consumer driven. But people ran it up because of this idea is that they're going to have this big explosion growth. So Disney's now going to be the next Netflix. Now, what they all forgot about this was that they forgot to extract out of all those numbers the cost of production of all the movies they've got to produce to meet that demand that they're going to have from 86 million subscribers. So the profitability has now been more than priced into Disney for the next 5 years. But the point, though, about that is that this is that you don't see in a major market cap company like Disney a 15% move in a day unless you have a lack of liquidity. And what that means is that there are basically no sellers, and you've got buyers willing to buy the stock and they're willing to pay any price for it. So sellers go, yep, run that price up and I'll finally reach a point where I have to sell it or where I will sell it. So, this is the problem. There's a saying that I've heard this a tremendous amount now over the last few days. There's a record level of cash on the sidelines. There is no cash on the sidelines.
You hear that every year.
Every year. And it's a great bullish argument, but there's no cash on the sidelines. Why? Because for every buyer, there has to be a seller. So whenever somebody buys something in the market, somebody had to sell their shares. So the net transaction is always zero. So if there's a pile of cash magically sitting on one side of the market, when it comes into the market, the other side of the transaction will sell to meet that buying demand. The net liquidity is zero. The problem today is there is no liquidity because there are no sellers. Nobody's willing to sell until the price reaches a point that you can drag sellers into the market. Now, here's the trick. It works in reverse. When prices begin to fall, the buyers will evaporate and the sellers will be rushing in to sell. And that's why you see declines like you saw in March, where it's a 35% decline in a month or a 10% decline in a month, like we saw in both September and October. It's because buyers will buy much lower and sellers will sell much higher. And that's what's causing a liquidity issue within the markets. And that's ultimately going to be a problem down the road.
Well, but let's get back to the root of the problem is that we still have so many people that aren't participating in markets.
Yep.
We have
I'm sorry, I deviated.
No, but it all kind of flows together. I mean, you have people that don't have the access to even go out and buy Disney on their own. Now you have Robinhood, you have other things that make it more accessible, but that also that probably magnifies the problem in some ways, because now we can do things that we typically wouldn't, and we can do them at a much quicker pace. And so that emotion gets involved, which is why I believe, you talk about the flashy lights, all the things in Vegas. Well, it's the same thing for consumers. And that's why you have half the people making over 100,000 they're afraid they can't retire. And, you look at different articles, and I mean, we pulled one up here, and it says, well, don't worry, save $300 more, and you're going to have $300,000 in 27 years. It's like, wait a second, at 8%, granted, every single year.
Right.
And so that's...
But why want to get 8% every year? I mean, the market just goes up.
Yeah, well, of course. I mean, have you lost money? I mean, if you don't sell, you never lose. I mean,
exactly.
That's the old moniker, right? But the other thing is, everybody says, well, invest aggressively. And so you're seeing a big push towards that. And, I think that's a little bit misleading in so many ways, because we don't understand, especially once you're near retirement or you're taking distributions, that's a game changer. Because investing aggressively is part of the problem, I think, for many people who maybe they didn't save enough. They didn't save, and now they're doing that. But what ends up happening from there can be really detrimental.
Well, that's because you have to go to the second part of the article, which we'll talk about when we come back from the break, which is you also have to alter your retirement plans. What? We'll be right back after the break. I'm your host, Lance Roberts. Get by the website, realinvestmentadvice.com. We've got a couple of new articles out on our website now. Michael Leibowitz has his latest post up, as well as we have a very interesting article about what investors need to know about investing. That's on the website now, at the website, realinvestmentadvice.com. Send your questions, comments, emails. Let us know what we can do for you. Be right back.
You're listening to The Real Investment Show.
This is Lance Roberts, CIO, wishing you and your family the merriest Christmases from all of us. Well, merriest Christmases is not grammatically correct. But it's the merriest of Christmases, if you want to say plural. This is Lance Roberts, Chief Investment Officer, wishing you and your family the merriest of Christmases from all of us at RIA. And this is Lance Roberts, your host, wishing you all of the best in the new year from all of us at RIA Advisors.